To today's Monday morning mortgage update. My name is Sean Woland with the Woland Mortgage Team here at Waterstone. And it's going to be an eventful week this week. We have a lot to talk about, but I wanted to go over a few things. I'm going to share my screen now and then jump right into that. One of the things I'm going to go over today is how to prepare the best offer for your customers using seller concessions to make sure they understand exactly the payment they're going to get, how much to ask for, and really before you make an offer, really fine tune this to be the perfect offer based on the cash to close requirements for the buyer and their payment budget. So we're going to go over that in just a minute. But first, I'm going to go ahead and share my screen and then we'll jump right into today's Monday morning mortgage update. All right. So first off, I want to kind of talk about listings because a lot of buyers are coming to me right now and they're saying, hey, there's a lot more on the market than there right now. What's going on? Well, it's just that time of the season. And here's the seasonality. This is new listings and the up-down seasonality effect over the last several years showing exactly what happens this time of the year. So you can get these from Fred, which is an online resource online that you can get for basically any data you can even want. I mean, there's so much in here. But this is the housing inventory. And as you can see, it goes up, down, up, down, up, down. And notice though, in COVID, notice where we are compared to COVID and where we are even before that. We're very normal. In fact, maybe below where we normally are. So it's a really interesting chart to show if you have buyers saying, you know what, or listing people that are listing their homes thinking, I don't want to do it right now. There's too many homes in the market. Well, compared to normal, there's not. So this is a really interesting chart. I always find this fascinating. The next one is active listings. Now, COVID, there was a really low dip because their inventory was down, but we're on our way up right now. But the chart is still very similar, up, down seasonal effect. And notice the amount of active listings currently compared to pre-COVID. We're still under that as far as the number of current active listings across the country. So it's really an interesting chart to show people. And I find it fascinating. But a lot of people are still waiting for rates. So what on earth are rates doing? Well, let's dive into that right now because we're at a little bit of a stalemate. This is the Fannie Mae 30-year mortgage-backed securities, universal mortgage-backed securities. As you can see, we're trading, each one of these little candles is 1 day of trading. Very small moves within a tight range up down here for the last several months, all the way back to January. And then the war happened. So that was rates right here. They dipped to 5.99 this day right here. That was a little 5.99 dip. If you go back over here on the left, that was another even lower than 5.99 dip. Very, very, very temporary. But notice this Fibonacci level, this line right here. It is stubborn. We do not want to go above it. We try a lot. We tried a lot over the last 4 months. We went above it, came back down. And then the war happened. The 5.99 rates, the dream of 0 points at 5.99 quickly faded. And every day, blah, 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 blah. You kind of know what happens until about a week and a half ago, we saw the rebound. Now we came up here all the way up above into this 200-day moving average, and we're kind of stuck there right now. Hopefully, the inflation numbers for this week will come through, and we'll continue to rebound. But we have a couple layers of resistance ahead of us. We've got the 25-day moving average, we've got the 200-day moving average. So we're bouncing right up that right now. Now, if you look at the 10-year, this is going to be important because right now, we started the day up here. We're below this. We want the 10-year to end the day below this Fibonacci level right here. We're starting to just squeeze below it now. We want to end the day below that because then we can go drive it all the way down here. Because when the 10-year goes down, mortgage rates go down. Inversely, when the 30-year goes up right here, mortgage rates go down. So when this goes up, mortgage rates go down. And then when the 10-year goes down, mortgage rates go down. So very interesting to watch that. But here's what's going on this week. We have a big active week. We have non-manufacturing ISM numbers today. That was kind of mute. We're up a little bit on that. ADP weekly preliminary estimates, durable goods, which is like the imports and for cars, washers, dryers, those types of things. 3-year Treasury note, bond auction, basically. We have another auction on Wednesday. And then we have the Fed minutes, which are going to be reviewed and published. That's going to be interesting to see on Wednesday. And then right here, we've got PCE. Now, this is the inflation numbers. Excuse me. I'm a little worried about this. We've had gas higher for a while now. So this on Thursday and on Friday, the CPE or the CPI, Consumer Price Index, it's going to be really, really interesting to watch. I'm going to be very careful moving into these couple days to see what's going to happen to rates because if inflation numbers come up hot, it's bad for the mortgage-backed securities, bad for mortgage rates. So Thursday is going to be an incredibly important day. I will be watching this incredibly close for those people that are shopping for homes because it could mean, a quarter move here or there, up or down in mortgage rates just in one day. So we'll really keep an eye on that and be very careful in watching that.
Hey,
Uh,
Sean, I have a quick question. On the
yeah,
chart that you have the R2, um, that chart, what does that stand for?
the chart. Let me just share my screen again. Hold on one second.
Sorry.
No, that's okay.
It wasn't the 10-year, it was the one before that.
That 30-year mortgage-backed securities. So
Okay.
let's see. It's dun, dun, dun. Let me go back to this one. This one right here.
Yeah, so this is the 30-year. Okay,
This is
so
the
30-year.
30-year
Uh-huh.
mortgage-backed security bond.
Okay.
So it lost value like crazy this last month, March 1st, all the way to the end of March, and then finally regained ground. When mortgage-backed securities lose value, rates go up. When they gain, rates go down. So as you can see, this last couple days, we've kind of been stuck right in this Fibonacci level. We don't know where to go. Hopefully, we'll go higher on that. But great question. So this is the UBS, Universal Mortgage-Backed Security 30-year coupons.
And the R2 175, that's significant because
R2 175.
that
Oh, right
line
here.
right
These
there
are the
in blue.
Fibonacci levels.
Okay.
So in the trading world, Fibonacci's levels are like ceilings of resistance. When
Okay.
you go above one, you pierce through one, then it's easy to get to the next level. But they act as like a ceiling of resistance or a floor of support. So if you look at this one right here, right here, let me just zoom in on it a little bit. We went down and bounced right on that level. It was because it was a hard floor of resistance and we went up. As you can see in other ones, we try to go through here, but it bounced back down. We try to go through here, bounce back down. We try to go up to it, it bounced down. So they act as like resistance levels. So when you look at where we're at,
Hmm.
that's why I'm really watching the 10-year. Whoop. I'm really watching the 10-year because the 10-year is just pierced below this. So now if we end the day below this Fibonacci level, which is the S1 4.332, if we end below it, it'll be easier for the 10-year to fall to the next level. It's kind of like gravity. Once you end the day below it, gravity will pull it down to the next level.
Got it.
Yep. So good question.
Interesting.
Yeah.
Okay.
These charts are available for stocks, for everything. You kind of watch it. But these trends are very strong. And these ceilings and floors are like, look at this one. It ended right on it. It stopped right on it, right? And it went below it and came back up, stopped right on it right there. So yeah, they're very interesting to watch. It helps me predict kind of what rates will do.
Got it. And I'm assuming that there's an algorithm determining what that floor or ceiling is.
There is, it is already predetermined based
Okay.
on, and yeah, so there is. And then as far as how the trading goes for that day, I mean, you could see huge swings like this one right here, where it went through 2 Fibonacci levels in one day. That's rare, but yeah, it's scary when the markets move that fast. So good question. Now, creating the perfect offer. I'm going to share my screen again with you, but here I'm going to get out of my PowerPoint presentation completely, and I'm going to share what I call the mortgage coach. Now, in this market, buyers, when they're making an offer, they want to see exactly what to expect. They want to know exactly what their payment's going to be. Like, okay, here the purchase price is X. So what if we asked for a certain amount of money, and what would that look like to you, to the borrower? So what I've done is this is the presentation that gets sent to my customers, and then I walk them through it really carefully. So in this circumstance, let's just say the purchase price is 570, and they're just like every other buyer. They want to lowball the heck out of it and get as much money as they can to do a 3-2-1 buy down or a permanent buy down to get their payments as low as possible. So I present to the borrowers, okay, if you want to make a 550 offer on that 570 project purchase, you can, and this is what it would look like. So if we're doing a 3-2-1 buy down, and when I highlight it, it highlights on their side as well. If I do a 3-2 buy down, the cost of that is going to be $21,848. So if we make that offer at 550 and we do 10% down, you're going to be looking at a first year payment at 3.25, and your total payment would be 2714. Now, if they come back to us and say we're only going to give you 11,000, and here's how it looks like here. Okay, then we can only afford a 2-1 buy down, and then your payment will be 2995. Now, in this, as we go back and forth here, I can click on this little bubble right here, click more info, and show them what the breakdown is. We've got the principal and interest, the property taxes, your homeowner's insurance, the mortgage insurance, the HOA, and then the total payment below. So I walk them through exactly what every single piece of this looks like. So we have illustrated 4 scenarios side by side. Let's just say the borrower says, you know what? I don't know if I want to do the 3-2-1 buy down or the permanent rate buy down. What's the difference? And I say, okay, on the 3-2-1 buy down versus the 2-1 buy down, here they are. You're going to get a huge discount on the 3-2-1 buy down for the first year, but the second year that's going to go up to $2,995. The third year that's going to go up to $3,293, and then the fourth year is going to be $3,600. Or you can do the permanent buy down with the same amount of money and have a payment at 3,200 for the whole entire process. Now, if they say, okay, let's only look at these 2 columns, I can then live with them change this so it's just these 2 columns, and then it'll change it live on their computer just like that. Now, the nice thing about this is we can go over what it's going to look like when they make the offer. But let's just say they make the offer and the seller says, we are 1 day on the market. You're high. I don't know what you're thinking making this offer. But here's our counter offer. And they offer back to us like 375 with $5,000 back. Well, that time we need to regroup and we say, okay, well, now we have this counter offer. What do we want to go back and do? We don't have enough money for the 3-2-1 buy down, that's for sure. So we'll take that out. So let's just focus on a permanent rate buy down now. So I can go in here and I can make this change live with them and say, okay, let's look at what we have to offer. And let's change this permanent credit. Let's do this live with you right now. And let's say, okay, based on the counter offer we just got, again, I'm changing this live, so bear with me real fast. What would the payments be based on what they actually came back to us at? So if we change this to 570, we're still doing 10% down. This is going to start to change live in front of us. And now we only have a certain amount of money. We don't have the 21,000 seller credit. We only have 5,000 seller credit. So now what do? We don't have a lot to buy the rate down. What would happen if we made an offer that is maybe 5,000 less than that and no concessions? So we have 565 and don't ask for any concessions. So we can't buy the rate down. So now we have a 5K off price compared to doing a permanent buy down with 5K seller buy down. So now we look at it based on reality, right? Okay, we really want this house. Now do we say, okay, instead of in lieu of the seller credit, let's just do a 565 purchase price versus 570. So with 565, 10% down, the rate would be 6.25 in this model. If we use 5K to buy the rate down, we'd be at 5.875, and we're at 5. So here we are presenting these two side by side. Boom. So now we're at 5,000 purchase price off the 5,000 off the purchase price at 565, but nothing towards buying the rate down. So at this point, we would say, okay, if you wanted to accept this offer, you would have a payment of 36.94. There's no temporary buy downs anymore. If you were to go full price and then keep that 5,000, you would be at a 5.875, would buy the rate down there, and your payment would be, even at the higher price, your payment would be 35.99. Now, if they said, well, Sean, what if we did 575 because I think it'll appraise for more, and then we ask for 10 grand? Well, we can do that as well. And then we can get down to like a 5.625 rate, and then we can add back in a third option now. And we can call that 5K over with 10K seller concessions. And we just go through this drill, and now we look at it and say, okay, the lowest payment possible is if you go 5K over asking, it has to appraise. And then we take that 10K now and we apply that towards the rate buy down. Now we're at 35.44. So 5K off the price is 36.94. Using that 5 grand to buy the rate down, 35.99. The lowest potential, you save $149 a month by going back to them and saying, you know what, I think it'll praise. Let's make the counter offer now to 575 and ask for 10 grand because it's the same net that they'll get at this one right here, or this one for that matter. They all net the same to the seller. So we'll go over that in detail with that borrower, and then you make the offer now or accept the contract. But going into the offer process, knowing exactly what you can or cannot do and what the numbers shake out to, and the final cash to close figure is very important with buyers today. So we do this with every single buyer, and we'll go through multiple. I've seen 8 counter offers going back and forth with utilizing this to say, okay, now what do we do? What can we do here? What can we do there? Can we raise the purchase price? Can we lower the purchase price? But if you notice, typically a lower purchase price with no rate buy down would be higher in payment than a higher purchase price with a lower rate. So if you compare these 100% of the time, it's always cheaper to get a higher purchase price with a lower rate. This is what a lot of buyers don't see. They can't really wrap their brain around until I show them this presentation. Because usually you think, well, if I can get the house for cheaper, that's always going to give me the better rate. Now, here's another factor. What happens if the buyer says, well, I know rates are kind of high right now. What if I wanted to refinance for the future? What would be better then? And then we can explore that in more detail as well. So this presentation with buyers is incredibly important to have before you make the offer so they know exactly what to expect. Because what if their maximum budget that they set was $3,500? And even with this one, the lowest possible payment, it's $35.44. And they say, well, you know what, even with this scenario, it's still above our budget. What can we do? Then I say, well, if you wanted to pay an extra $2,500 yourself, we could buy out the mortgage insurance. We could lower your rate even more, and we could get you down to a $3,450 payment. Would you like to see that? And then they say yes. And we go back and forth on this until they have like the perfect Goldilocks scenario that they can respond back to the seller on. So it's important. Buyers love this because there's never a question. There's no fear going into it as to what the payment would be. They'll know their exact cash to close within, a couple $100 here and there. And it's just a great way to present to your buyers before and when they're making offers. So any questions on how I do this? And do you guys see the value in doing this to really help your buyers mentally? It's a pretty cool system. I've been doing this same presentation for years, and it really is enlightening to borrowers. And they also show them kind of how it works. So I'm going to take you back to here. If you go to a rate sheet, first off, this is what a rate sheet looks like. So if you want to buy the rate down permanently, let's just say rates today in this model, this program is a first-time home buyer program. This is a 6.125. Okay. If they want to go all the way to 5.125, the cost of doing so is this right here. Oh, let me go back. Sorry. 4.5 points to get there. So you would have to ask the seller for 4.52 points to get that rate. You can get it today. So if you ever wonder why, like what, if somebody says, what's your rate, Sean? I'm like, well, it depends. Is how much do you want to spend or how much do you want to get? Because if you look right here at the bottom where it says 6.5, it's at 100.928. That means I, the lender, give you $4,942 at this rate. So I'll give you that money and you can use it to pay your closing costs. So you can get any rate you want. So when you look online at all the advertisements for rates, we could do a 3-2-1 buy down rate option. We can show you all of these different rates, all with different closing costs, and advertise individually each of these. And we can make the phone ring by just advertising today. Our 30-year fix is at 5.125, and then an asterisk that says APR, and then it's much higher. So it's hard when people say, Sean, what's your rate? Because you can really get any rate you want, depending on how much you're willing to pay or the strategy with the seller. Now, one of the biggest roadblocks we have is look at this 5.125. That costs 4.52 points. Now, this is what I want to show you because this is important. This is a chart, a little cheat sheet to show you how much you can ask for. Because if you need 4% to get where you want to be, and you're putting less than 10% down, you can only get a 3% seller contribution with a conventional loan. And that's the loan we have. So you're going to be capped at 3%. So when we're looking at how much we can give, it's important that we understand the maximum gift or the maximum credit you can get from the seller. FHA, you can get up to 6%, but notice the more you put down, the more you can get. So you can actually get, if you put more than 25% down, you can get 9% with conventional, but I've never seen anyone give it. I've never seen a seller give that. But really important when making offers to let your buyers understand exactly what they're going to get, exactly what their options are, how much the maximum is they can get, and how to utilize that properly. So that's the perfect presentation to a borrower so that you are set up for success when you're making an offer.
Sean, quick question.
Yes.
What are you typically seeing for rate buy downs? Are you seeing about 3% or 2% or 2 points, or is that
Yes.
kind of the norm right now?
Yes. So if you're looking at the lower price ranges, when I say lower, I mean anything under 400. I'm seeing a little bit more because it doesn't look as dangerous when you're asking for 5 or 6%. I recommend you use dollar amounts when you're going above 3% because it doesn't look as bad than 6%. But I'm seeing most of these coming in right around 2 and 3% when it all shakes out. Because let's just face it, sellers don't want to give away the farm. Now I have a couple. Now listen to this. Here's another trick. If you want to do the above asking option and you're making that offer, I can actually this is if you're putting 10% or more down. I can run it through our system to see if we get an appraisal waiver before you make the offer. That way there's no fear of it not appraising. So if you want to make the offer at 575, but it's listed at 570, but you know it's going to appraise for higher, Well, let's see if we can get an appraisal waiver so well, that fear is gone, so the sellers don't have that fear either. And you can make the offer non-contingent on the appraisal. So there's some real cool tricks as we navigate these waters, so to speak.
Oh, that's very interesting. So if the property is, let's just say 600,000 and they're putting 10% down, then and asking for a concession, then they could potentially waive it. Is that correct?
Yes, so Fannie Mae and Freddie Mac have their own algorithms of what home properties are worth within their database. And depending on the home, they may have enough data for that surrounding neighborhood where they say, you know what, we accept this value, but you have to have at least 10% down on a conventional loan only in order to have the opportunity to get an appraisal waiver. That's why we want to run it first because it's not a guarantee. We want to run it first. So what I've seen any older homes like pre 1980 are it's really really hard to get an appraisal waiver. Any homes that are over $1 million, it's almost impossible to get an appraisal waiver. So the sweet spot are homes that are 30 years or younger in age and between or under that $1 million range in order to get an actual appraisal waiver. But we're getting quite a few.
Okay, cool.
Yeah. Another piece of that puzzle, right, to make the best offer possible, especially when there's competition. If we can get an appraisal waiver, and then when we make that offer, we make it non-contingent on the appraisal, you know how much more power that gives you compared to one of the other offers? The sellers will love that, especially if you're trying to go over asking to get more concessions. So that's all stuff we run through together as a team as we're making offers on these properties. So keep that in mind as with your next buyer to make sure we're meeting to going over those in detail.
I think it would be really smart for someone who's in the middle of negotiation to come back to you because these are
Yeah.
so many little details that it's hard to remember or know or so getting a counteroffer as a buyer and coming back to you and saying, okay, here we are. What's the best
Oh, 100%.
way forward? I think would be the best option
Here's a
because
text
you're the experts, sir.
here's a text I just got this morning on a scenario we're just in. We need to find $4,000 to make this work. Give me a call to go over this in detail. So that's in the middle of an offer. They're relying on me to present how we can get $4,000 to make this work. So perfect example. There it is right there. Boop, boop, boop. We need to find $4,000 to make, I can't give you the details, but the buyer's names, but that's just another example of it in process because it helps, it works, and it really makes the buyers feel great. All right. Well, that was about 30 minutes, a little bit long, but I wanted to make sure you saw this, you understood kind of how it works, and you get your buyers involved in the process with me up front all together as a team to make the perfect offer. And then when we get a counter, make the perfect counter offer as well, or they accept it. So if you don't have any further questions, I will step off and let you guys get to your week. Otherwise, you guys have a wonderful, wonderful day, wonderful week, and I am here to help. So I'll stay on a little bit longer if you guys have some further questions.
Thanks, Sean. Appreciate it.
Yep, you're very welcome.
Thank you. Bye.
Very welcome.
Sean, you there? It's Joyce.
I'm here.
Okay, I loved this presentation. So if I heard this correctly, we try to get as much as we can from the sellers, to do a buy down. But if we get, say, 2% from a seller, then if the buyer wants to throw in another 2% or whatever it would take to do a really big buy down, or I think looking back, I didn't really think that doing a full buy down, like for the entire length of the loan, I didn't realize it was that expensive.
Yeah, it's
I
not
thought it would be
cheap.
horrible.
Yeah.
So
Yeah,
go ahead.
absolutely. Absolutely. So ask for as much as you can. Once
Mm-hmm.
we get the counter back, we'll see what we have and then kind of formulate a new plan of attack. There are some fees that you cannot pay for as a buyer. A buyer cannot pay for their own temporary buy down. The seller is
Okay.
the only one that can cover that.
All
The
right.
permanent rate buy down, absolutely, the buyers can put their own money into that as well. So if they have a number in mind that they want to hit, and the seller's not willing to give it all, you can have the buyers come in with that little extra cash to make it happen.
Okay. Another quick question. I didn't realize you could buy out the insurance, the mortgage
Mortgage insurance.
insurance.
Yes. So
Really?
next week, I will go into extreme detail on mortgage insurance and the options
Mm-hmm.
available to you.
Mm-hmm. Perfect, as always. Thank you so much.
You got it. And it's always a pleasure hearing your voice, Joyce.
Thank you.
All right, everyone. Well, have a phenomenal week, and we will be in touch with you very soon.